Even if you're just starting out in trading, chances are you've encountered the term scalping at some point. It's akin to day trading in that you aim to make quick profits during a trading session, but it operates on a much faster and smaller scale. So, what exactly is scalping? Scalping is arguably the riskiest trading strategy you can undertake. Many traders avoid it and opt for long-term trading instead. Some argue that due to its fast-paced nature, it can easily resemble gambling. However, that doesn't mean you should completely rule it out as your preferred trading strategy. When executed simply and effectively, scalping can be highly profitable. If you're wondering how to get started with scalping, we'll discuss some key tactics to help you determine which scalping trading strategy might suit you. But before you dive into scalping, let's clarify exactly what it entails. In the realm of forex and stock trading, scalping generally involves executing numerous trades, each yielding small profits. Instead of holding positions for hours, days, or weeks, scalping aims to generate profit within minutes, typically gaining a few pips at a time. A scalping trading strategy finds its prime application in currency investment, although it's also prevalent in futures, stocks, cryptocurrencies, and even commodities like gold. Many traders favor scalping due to its abundance of trading opportunities within a single day. Its appeal largely stems from the relatively high probability of obtaining entry signals in most trading strategies. Throughout the scalping process, traders generally aim for gains of no more than 100 pips or losses of no more than 50 pips per trade, including spreads. To translate those gains of 100 pips into substantial profits, scalping is typically executed with high volumes. By maintaining consistency in this approach, traders can potentially reap stable and steady profits. What's the optimal time frame for scalping? Are you into scalp trading on the 10-second, 1-minute, 2-minute, 5-minute, or 15-minute chart? Typically, most scalping traders operate on the 1-minute and 5-minute charts, but there's another faction that delves into time frames shorter than 1 minute. Personally, I prefer to scalp trade on the 1-minute chart because it aligns with my trading style. I also employ the RSI or Moving Averages Relative Strength Index trading system for scalp trading on the 1-minute time frame. This scalping strategy serves as a solid starting point for novices, as it's relatively straightforward to implement. However, bear in mind that this strategy requires a certain level of time commitment and focus. If you're unable to allocate a few hours per day to trading, it might not be suitable for you. Following time availability, the next crucial aspect is the ability to think swiftly on your feet. For a scalping strategy to yield profits, you must swiftly anticipate market movements and execute trades within seconds. When formulating these trading predictions, it's essential to factor in herd psychology, which significantly influences market dynamics. So, if you believe scalping strategies suits your style, let's proceed to the next section. Best scalping trading strategy. We've presented a straightforward yet profitable trading strategy, along with advanced techniques applicable to the forex and stocks market. Whether you're a novice or seasoned trader, the optimal choice will depend on your day trading style and objectives. RSI scalping strategy. Given that this is a scalping strategy, we'll exclusively utilize the 1-minute and 5-minute charts. For those who aren't accustomed to rapid trading, the 5-minute chart may be utilized, although it leans more toward a day trade time frame. Both timeframes come with their own set of advantages and drawbacks. The 1-minute chart tends to have more noise, but personally, I find it easier to predict due to the brief duration I hold trades within this timeframe. On the other hand, the 5-minute chart typically exhibits less noise, yet I've noticed that market sentiment could easily reverse during the time I hold trades on this chart. Using moving averages crossover as a short-term trend indicator. Because moving averages lag, the crossover technique might not precisely capture tops and bottoms. However, it can assist in identifying the bulk of a short-term trend. A moving average crossover aids in addressing 3 questions. First, in which direction might the price trend, if at all? Second, where could be a potential entry point for a trend trade? Third, when might a trend end or reverse? All you need to do is add a couple of moving averages to your chart and wait for a crossover. If the moving averages cross each other, it could indicate an impending trend change, offering you a chance for a better entry. With a better entry, you have the opportunity to capture more pips. Let's revisit this 1-minute chart to illustrate moving average crossover trading. Using the 10-period RSI as a trade signal to identify the best entry. Certain scalping trading strategies harness market momentum to determine optimal entry and exit points. The relative strength index functions as an oscillator capable of forecasting the future direction of an asset over a specified period. The RSI assists in identifying overbought prices. Specifically, if the RSI exceeds 75, the market is considered overbought, while if the RSI falls below 25, the market is deemed oversold. The most effective approach to integrating this oscillator into your scalping trading strategy is by configuring it on a 1-minute chart. Developed by J. Wells Wilder, this technical indicator evaluates both the direction and strength of price trends, empowering traders to decide whether to initiate or terminate a trade, refrain from trading, or augment an existing position. Consequently, the indicator can furnish trade signals when it behaves in a particular manner. The RSI indicator can indicate the robustness of a trend. When a trend displays vigorous momentum, there's a heightened likelihood of price continuation in the same direction. Therefore, whenever you seek to gauge the strength of a securities trend, simply refer to the RSI indicator's indications. The range between 45 and 55 on the RSI indicator signifies a price consolidation area. Therefore, if the RSI line is above the 55 level, it is assumed that the market is still in a bullish condition. Consequently, traders can maintain their buy positions as long as the RSI line remains above the 55 level. Conversely, when the RSI line falls below 45, the market is presumed to be in a bearish condition. Therefore, traders can hold on to their sell positions as long as the RSI line remains below the 45 level. Utilizing the RSI as a trade signal indicator proves most effective when coupled with trend indicators like moving averages. This synergy aids in pinpointing market bottoms during an upswing or peaks during a downtrend. In essence, by employing the RSI as a trade signal indicator, you can fine-tune your entry timing within a trend. In this example, you have the 34-period and 10-period simple moving average or SMA applied to the price chart. When the short-term SMA is above the long-term SMA, it signals an uptrend. Now, by using the RSI indicator, you can observe that bullish momentum is revitalized each time the 10-period RSI falls below 55. When the RSI indicator begins to climb back above 55, the bullish trend resumes, thereby providing traders with a favorable entry point into the trend. Ensure to set your stop loss at the swing low formed by the bullish price surge, and set the take profit at 2 times the risk on the stop loss. For a sell entry, wait until the short-term simple moving average is below the long-term simple moving average, signaling a downtrend. And now, utilizing the RSI indicator, you can notice that bearish momentum is rejuvenated each time the 10-period RSI rises above 45. When the RSI declines back below 45, enter at the candle close corresponding to when the RSI crosses below 45. Set your stop loss at the swing high created by the bearish price thrust, and set your take profit at 2 times the risk on the stop loss. Ensuring that trading signals have high accuracy by utilizing confirmation of price action patterns. This is one of the most effective ways to enhance the accuracy of any scalping strategy. Namely, only initiating a position when a trading signal is supported by a price action pattern, such as pin bar, engulfing, triangle breakout, etc. Here are some examples. Now you have the 34-period and 10-period simple moving average applied to the price chart. When the short-term SMA is above the long-term SMA, it signals an uptrend. Now, by using the RSI indicator, you can observe that bullish momentum is revitalized each time the 10-period RSI falls below 55. When the RSI indicator begins to climb back above 55, the bullish trend resumes, thereby providing traders with a favorable entry point into the trend. In this formation, it turns out that a bullish engulfing price action pattern has formed. Therefore, this is a high accuracy buy signal. Ensure to set your stop loss at the swing low formed by the bullish price surge, and set the take profit at 2 times the risk on the stop loss. For a sell entry, wait until the short-term simple moving average is below the long-term simple moving average, signaling a downtrend. And now, utilizing the RSI indicator, you can notice that bearish momentum is rejuvenated each time the 10-period RSI rises above 45. When the RSI declines back below 45, enter at the candle close corresponding to when the RSI crosses below 45. In this formation, a bearish pin bar price action pattern has emerged. Therefore, this is a high accuracy sell signal. Set your stop loss at the swing high created by the bearish price thrust, and set your take profit at 2 times the risk on the stop loss. Next, in this chart, wait until the short-term simple moving average is below the long-term simple moving average, signaling a downtrend. And now, utilizing the RSI indicator, you can notice that bearish momentum is rejuvenated each time the 10-period RSI rises above 45. When the RSI declines back below 45, enter at the candle close corresponding to when the RSI crosses below 45. In this formation, it appears that a bearish gap price action pattern has formed. Therefore, this is a high accuracy sell signal. Set your stop loss at the swing high created by the bearish price thrust, and set your take profit at 2 times the risk on the stop loss. As seen in the examples above, we can conclude that this is a highly productive scalping strategy for making money in the forex, crypto, commodity, and stock markets. The combinations of indicators I have explained in this video can be manually applied as they are not difficult to implement. However, if you need these settings, I have already provided them in the video description column. I have included a template with a system that you can easily apply to your charts, automatically plotting all these indicators accurately. This way, there is no need for any additional complexity. Get the download link in the description. Frequently asked questions. First, is using a scalping trading strategy profitable? Scalping can indeed yield profits for experienced traders. However, it's essential to note that volatility in the forex market can be unpredictable, especially when monitoring small price fluctuations. Since scalping operates on small timeframes, traders must act swiftly to capitalize on trades and secure profits promptly. Second, is scalping a good trading strategy? Scalping is favored by experienced traders, but it's also suitable for individuals who can consistently monitor the market and thrive in high-pressure trading environments. Beginners should fully understand the risks associated with scalping before engaging in it. Third, what is the best scalping trading strategy? The best scalping strategy varies based on personal preference and the trader's investment objectives. Fourth, is a scalping strategy the same as day trading? While both involve short-term trading, scalping focuses on exploiting small price movements with large volumes, whereas day trading typically involves holding trades for a larger profit target. For instance, day traders might employ strategies like the 500 pips a day strategy using a 1-hour chart. Fifth, what is scalping and options trading? Options trading involves derivative contracts that grant the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price and time. Scalping and options trading entails buying and selling multiple options within a single trading day to secure small profits. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or X to show your support. See you next time.